Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone. I'm Kavita Baratake. I'm here to talk to you about how to build wealth in real estate. The goal is to accelerate your investing, diversify your portfolio, as well as create generational wealth. A lot of you folks on here are probably investing in the stock market, diversifying across a lot of different stock market assets, mutual funds, and all of that stuff. But this is how to step into real estate without worrying about buying a single family home. That's kind of the goal of this discussion today. I want to talk a little bit about what are the many ways to invest in real estate that people don't know about. And I'm Kavita Baratake. A little bit about me, I'll give you a quick intro. This is sort of an agenda we're going to cover today. Why invest in real estate, right? There are very good reasons to invest in real estate outside of the market. Even if you've gotten a great run in the market, as we have the last few years, there is still a very good case for investing in real estate, and I'm going to go through what that is. Why the wealthiest people in America invest in real estate. Let's talk about that, right? What are the different types of real estate? A lot of people, when they think about real estate, I just know, okay, I want to go buy a single family home. I want to rent it. I want to have a tenant. I don't want to deal with it. They look at investing in real estate as buying a single family home, but there is so much more to real estate than that. And people don't think about commercial properties. The reason is the cost seems prohibitive, right? It's not always the case. And this is kind of the goal of this discussion, to talk about how you can invest in other assets, how you can not take on tenants and deal with all the headache while you continue to do your job, and create passive income in real estate. Also talk about diversification, what it means to a lot of investors, what I've seen from investor profiles. I talk to thousands of investors, and what I see from a diversification standpoint in their portfolio and what's missing. And we'll talk about what is a syndication. Is anybody familiar with a syndication? If you want to do a quick raise of hands or something, you should have a little raise hands button somewhere on your Zoom. Let's see. Quick show of hands. A couple of people are showing hands, but I'm not seeing others. So there's a lot of reasons to invest in a syndication. Most people aren't aware of what a syndication is. I'll talk about that, and then also talk about how a syndication is typically structured, what are the legal as well as the return structures in the syndication, like how the investors get paid, what are the different types of investors that SEC recognizes, what is a 506B, what's a 506C. Let's talk about equity and cash, equity growth and cash flow. There are like two sides to the coin when you talk about growing your investments. You're kind of like thinking about it as, dividend stock versus stocks that appreciate in value but don't provide any immediate cash flow to you, right? So similar side of the coin is on real estate side, we look at equity growth and cash flow. My top 10 do's and don'ts, I'll see if I have the time to cover it, but if not, if we run out of time, then I might skip that and save that for another discussion. So why am I here talking to you guys? Because I've been through this journey. I have invested in the stock market. I have lost, I've made money. I've done all of it, right? I came here in 1998, like a lot of you out here. I came here for my master's degree in 1998 and graduated from Texas A&M. I spent a year in India, in Bangalore, working for Wipro. And then I came here, I graduated, and then I joined IBM. I was in IBM for 15 years and then joined Atlassian. For those of you not familiar, it's an Australian company. They went public. So I joined them 2015. I worked till 2019 and retired myself. I had retired myself thanks to real estate before that, but I just stayed on because Atlassian incentivized me, let's put it that way. After that, after quitting in 2019, I realized that I had a lot of things I had learned being in real estate for the last 10 years, and I wanted to share it with more people. And so I started my company, Cherry Street Investments. My goal has always been to educate people on investments, how to invest passively, how to create cash flow, how to grow their equity in real estate, how to take advantage of the tax advantages of real estate. I also offer what's called infinite banking or infinity banking. It's basically a life insurance policy that you can use for investing. You basically put money into the policy, overfund the policy, and then use it for real estate investing, sort of double dipping into from the policy. You can use it for college planning as well as a source of retirement for you. I also am a realtor, which honestly I don't do a whole lot of, but I'm happy to provide referrals if you're interested. I do have about 3,000 doors of limited partnership, which means I have about 23 deals I'm personally invested in. My own capital, every deal that I do put together, I always invest my capital too. And then I also have 1,900 doors. So what this means is GP is really like general partnership is what I do, my role in the investment, and I'll talk about that. So I do multifamily, land development, new construction, as well as the couple of senior living projects coming up. So if you have any questions at any time during this discussion, please look at the Q&A box and type it in there. So I host every webinar that I've done, and I've done about 90 something of these. Everything is on YouTube. You can go to Cherry Street Investor Education. I would really appreciate if you could subscribe there. I'm trying to increase more my reach for these investor education that I put together. And you can also join me every 2 weeks. I have a webinar on some subject. This is a personal, a webinar for you guys from Telugu Cultural Association, but I also do a lot of webinars, and I have investors from across the country joining me. Sometimes I speak, I call guest speakers, so I'll call attorneys, I call CPAs, I call other investors who do, let's say, medical offices, industrial investments, all sorts of investments. So one of the things I want to touch on is a lot of people worry that this is too big an undertaking and they get overwhelmed with investments. Even stock market, right? You might have put some money in the retirement accounts and you just kind of forget about it, right? At some point, you're like target 2045 fund, and then you just forget about it. But the key to starting investing, business, anything is just to start small and start today, right? Focus on one step at a time. You don't have to know everything, right? And time is really your friend. Like, I feel like a lot of people in the stock market and crypto, we are used to these huge gains in like one day, right? And then you suffer these huge losses the next day. So it's kind of like when you look at the sum total of it, are you still positive is the question, and depends on when you got in, right? If you got in when Bitcoin was 2000, sure, it's fine. It goes all over the place, but you're still positive. But if you're one of those unfortunate ones who got in when it was high, a lot of investors tend to buy things when it's hyped up and the market is high because they feel like they're missing out if they don't invest. And the problem is that's kind of the wrong time to invest, because the minute it drops, you panic and you sell, right? Kind of like the opposite of what you should be doing. And that's kind of why I like real estate. It's more focused on a long-term outcome, and it's not the short-term ups and downs. So you take advantage of the snowball effect because you're rolling from one investment to another in real estate. You're never really exiting one investment and not going to take the money back. You just keep snowballing and moving from one investment to another. So when I see a lot of investors, I talk to a lot of investors every single day, and they're all diversified in their minds. But what I see is here is that their idea of diversification is very different from what I would consider diversification and what the market really considers outside of the stock market, right? What is considered diversification in the financial worlds? So we look at a diversification as being across these four tiers, where the risk is very low in the lowest tier and the risk is very high in the highest tier, and the control is very high. So for the risk to be low, the control has to be high, and the control is super low. Most people go here and they put in all their money, where the risk is really high, the control, they have no control over what happens in the stock market, right? You have absolutely no control. 2008, my 401k was half the value it was, right? There was nothing I could do. We just sit there and wait for it to recover for years, right? So you never want to put your money all in this one bucket, because that's not diversification. You might be diversified within that speculation bucket in the stock market with mutual funds and bonds and whatever else. Yes, bonds are definitely less volatile, but they're still volatile, right? And mutual funds, for example, are still volatile. When 2008 happened, I was in mutual funds. I still lost a lot of money, right? Because underlying is still the stock, right? It's just diversified across the stock. If the stock market takes a hit, the mutual fund takes a hit too, right? So, I meaning the stocks take a hit, the mutual funds take a hit too. So the way we look at investing or diversification is to invest across these four tiers. And what are they, right? Savings and protection. Do you have a good savings account? Do you have protection on your life? If tomorrow something happens to you, is your family going to be protected against your loss of income? A lot of people say, oh yeah, my employer is going to pay 4 times my salary. Is that really enough for your family to survive for the next 20-25 years if your kids are young, right? Most of the time it's not. If you're making a $200,000 income, 800,000 will not take your family anywhere, right? It's not going to take them anywhere. So most people are underinsured, underprotected, and they consider it okay, and we live with those kinds of risks. So we start at the bottom and we make sure the base of this foundation is really strong, so that way you can take the money up and invest into what we call direct investing, whether you're getting education, whether you are buying a house, that's direct investing. And indirect investing is syndications, things like where it's less, the risk goes up a little bit more, but the control is also a little bit less, right? Than buying your own house, where you have more headache, but the risk is lower because you manage it. So for those of you who don't want to do that, like, it's good to diversify across this, because if you're owned a house, it's never really passive. You're actively managing your house, right? So most of them have 80-90% of the assets in this tier, and very little in these tiers. And so what I encourage you guys to do is to sit down and look at what you have in these three tiers for your investing, for investments and savings, and your protection of your life, and think about how you could solidify that investment better to diversify across these tiers, rather than just looking at a stock market and saying I'm diversified. So let's talk a little bit about stocks versus real estate. So how many of you are invested in stocks? Let me get a quick show of hands. Right. I see only two people invested in stocks. I think the answer is probably a little bit more than that. 3, 4. Okay, so a few more. Yeah, a few more. Okay, so a lot of you are invested in stocks. Obviously, the advantage is your liquidity is very high. Tomorrow you want to sell it, you can sell it. Real estate takes a lot more to liquidate. It's not a very easily liquidable asset. It takes longer. Not very hard to sell in this market though, but things take time to close and all that. That's definitely a downside of real estate, if you want to call it downside, because you do want to keep some of your capital liquid, right? But things like retirement, does it really need to be liquid? How many times you dip into your retirement for funds, right? It doesn't need to be liquid. So those are kind of ideal assets to deploy into real estate. And yes, you can use your retirement accounts to invest in real estate, but there's some catch to how you can use that, and I'll talk about that. Talk about the growth. Stocks can be super high, right? It can go super high. Like one day you can have like a 10%, 20% return. You're not going to have that in real estate for sure, but it's going to be strong and steady. As long as you pick a good location, it's going to be strong and steady. It can be killers. Like we've done one of our projects, we did 70% returns a year in real estate in our in Phoenix. So it can happen, but we are not banking on that, right? We are banking on slow, steady, keep going, constant, without any big dips in the returns. The volatility is very high in stocks. You have very low volatility. It just keeps going steadily. It might dip a little bit, but if we don't sell it, we don't take the hit. We don't go sell when the market dips, right? A lot of you might panic and sell when the market dips. We don't do that. The fees can be pretty high on the stock side, especially when you start getting into mutual funds and others. And you just don't see it, but the fees eat into your returns. So your net returns are much lower than what your little flyer for your mutual fund says, right? And this one is, fees are there, of course. We do syndicate real estate. We do need to get paid, but they're moderate. And all the returns we talk to you about is net of all the fees. It's after all the fees, okay? And the risk is high here with stocks, and I believe it's much lower with real estate. You can buy on margin here, you can leverage, but it's not quite the same because we're able to leverage 75 to 85% of the price in real estate. So that really allows you to get cheap money from banks and other capital sources and use your money for a down payment and renovations or whatever, depends on the asset we're buying. Cash flow is possible with dividend stocks and ETFs, stocks and ETFs that provide a dividend to you. Whereas in real estate, we have cash flow assets that make steady income. And I personally haven't invested in dividend stocks and ETFs, and I don't find the returns that fabulous. I might make 4 or 5% at the most, and then get taxes on top of that. So I'm really left with maybe 2 or 3% in terms of a dividend on that stock. Real estate provides much better returns on cash flowing assets. Also, the tax benefits really where real estate shines, and this is why the richest people will invest in real estate because of the tax benefits, right? There are no tax benefits to investing in the stock market. Maybe if you go to Puerto Rico and live, there are some tax benefits to investing in crypto, I believe. But the rest of the country, you're slammed with a lot of taxes, especially for short-term gains. You're paying at your ordinary income tax rate, just like you were earning income, right? And then states like California, people live in California, they get hit with more state taxes on top of that. So that's the biggest issue with stocks, is that your net return, net of all the taxes are much lower than what it seems. If you're getting hit with short-term gains, and let's say your tax bracket is like 30%, you're really making 70% of what you think you're making. So if you're making like 10% in the stock market, you're really making only 7%, right? So it's really net of all the taxes is what is coming into your account. So we have a lot of tax benefits with depreciation in real estate that can basically give you tax-free income for the period of hold, right? So if I tell you 8% cash flow, it is 8% in your bank account. There are no taxes due on it because there'll be so much depreciation that we collect, which is really a passive loss. We call it a loss, a paper loss. And then you will offset that income with the paper loss. So when you're talking about 8 to 10% typical investor portfolio returns, you're really talking 6 to 8%, depending on your tax rates and also whether it's long-term or short-term capital gains. We return a 12 to 15% for stabilized real estate investments like apartments, and about 20 to 25% returns for land and new construction. So obviously a much bigger return unless you start going in and trading individual stocks and making 30%. And there's just no guarantee that the 30% is going to stay, right? You could as well lose that 30% unless you cash in and make that money. So let's talk about, I'm just going to get all of them out just to minimize the time here. 10 reasons why you want to invest in real estate. One is there's cash flow and equity growth. If you have an existing asset, there's cash flow. Even if with an existing asset, there's cash flow and equity growth, which means you can benefit from the market appreciation, right? And there's also another benefit, and I'll talk about that a little bit. There's low volatility. I spoke about this. It doesn't swing all over the place. It's backed by a real asset. So today you're investing in this company, everything is great. You don't know how long that company will be around, whether it'll be around, right? Of course, there are these large behemoths that have been around forever, and they are backing that asset, the stocks that you're buying, right? But mostly stocks are driven by supply and demand. Like if people want to buy it, it goes up significantly. If people want to sell it, if there's a sell-off, it goes down significantly, right? But real estate is really backed by what the property is making, what the property is capable of producing in terms of income. And it's a solid asset. No matter what you do, the asset doesn't lose value unless it's in a terrible location or we have some really adverse event happening, right? We talk about location. You benefit by market appreciation, right? If you buy it in a good location, you always benefit from natural market appreciation over a period of time. And that's not the only way to make money in real estate. A lot of people think I'm going to buy a single family home, I'm going to hold it, and I'm going to sell it because it market appreciated. That's only one of the ways you can make money in real estate, right? There are many other ways. So what's value add? Value add is like the ability to buy a property and add value to the property. So we buy an existing apartment building, we renovate the units, we rent the units for much higher rents. The value of an apartment building automatically goes up if the rents go up and the income goes up, the net income of the property. So that's what we call a value add. And that adds even more growth to your money rather than just waiting for market to appreciate. We just force the appreciation on the property by adding value. We have diversification. That's something, again, we talked about before. We look at diversification within the stock market, but we don't look at diversification outside of it. So it's great for your savings as well as your retirement accounts to be diversified across multiple assets, not just stocks. Inflation hedge. This is a long-term investment. It's a good hedge against inflation for a simple reasons that our inflation officially is like 7.5, unofficially more like 12. So let's say inflation goes up, what goes up? Rents go up, right? Rents go up, cost of every product out there goes up. When rents go up, we benefit. If we are holding an apartment complex and rents go up, we benefit from that inflation in that particular asset because now we are getting more rent. So we actually hedged against that inflation. Let's talk about tax savings. This is 1, 2, 3 because there are 3 different ways to save on taxes with real estate. One is depreciation. As I mentioned before, this is simply saying that a piece of real property, which is not just land, a piece of structure, over a period of time, IRS says that the structure loses value. So you buy a dishwasher, the useful life of a dishwasher is 5 years or 10 years, whatever that is. You buy an air conditioning unit, the useful life might be 15 years. So IRS allows us to depreciate these assets because there is a useful life associated with it. Of course, you have houses which are 50 years old, And you might say, hey, what's the point of depreciation? But IRS still says, hey, you get to take paper losses on this property because everything inside that property is declining in terms of its useful life, right? So that's a huge tax advantage. So we get almost like 75, 100% of your investment as a depreciation back to you. And you basically have some paper losses that you can use to offset income from these properties. So you have tax savings too. 1031 exchanges. This recently came under attack with the Biden administration. It would never pass, right? It allows you to defer your taxes on real estate growth forever, forever. Literally, you can keep moving from one property to another, your money, and never pay taxes. And then if you pass away and your children inherit this property, their cost basis gets reset to the date of the inheritance and your taxes are wiped out. This is perhaps the largest way people generate generational wealth or create generational wealth in this country. So it's called 1031 exchange. That's one of the ways in real estate that you can avoid paying taxes. The third way to not pay taxes is this. This is a short-term investment. Sorry, not a short-term investment. It's a 10-year investment, but it's called opportunity zone funds. So if you have tax capital gains from stocks, crypto, it doesn't really matter. You sold a piece of art, you still have capital gains. You can invest it in an opportunity zone fund and it'll give you considerable tax benefits. So let me talk about what it gives you on a very high level. I'm actually setting up an OZ fund right now for one of our properties. These are special areas of where you have to invest in real estate. So IRS says if you invest in an opportunity zone identified area and you basically put money in there as an investor, of course, through someone or whatever, and you follow a set of rules, they get to defer your taxes till December 2026. Your taxes won't be due till 2027. And then also any growth in the fund is tax-free. So let's say your 100,000 became 300,000 in 10 years. Then that 200,000 in growth on your money, initial money, is tax-free. So it's an amazing way to shelter your capital gains. So let's say you made $100,000 investing in the stock market, and that's just your gains part. You get to remove your principal from there, your cost basis, and just invest the gains and have it grow in an opportunity zone fund. I'll be doing another webinar on opportunity zone funds next week on Thursday if you guys want to join me. And I'll send out the invite to people on my mailing list. If you guys want an invite, I'm happy to send one to Madhukar as well. Let's talk a little bit about commercial and residential because this comes up a lot. A lot of people here assume that when they talk real estate, it's single family homes, maybe one quadplex, maybe duplex. But there's so much more to real estate than that, right? So residential investments are 1 to 5 units, what we call 1 to 4 units actually, and 5+ we consider them commercial, right? But in our world, we don't really work with anything less than 50 units just because the numbers just don't make sense for us to take on if it's under 50 units. The capital is pretty easy for one of you to go buy a single family home, whereas commercial investments needs a high amount of capital. The cash flow is low. So let's say your one single family unit is not occupied, you're not making any money, right? Let's say have 100 units, 300 units. If 20 units are not occupied, we are still making enough money to pay for the property and pay the investors. So it gives us a lot more resiliency with vacancies, with people who are not paying, we call them delinquency. All of that stuff we're able to absorb better at a larger scale. The value of your single family home is based on what we call comps or comparable sales data, right? If your neighbor's house goes down in value, so does yours. Multifamily is not like that. Commercial is not like that. It's based on what we call the net operating income, as well as the cap rate of the market. So the net operating income is the income minus expenses of the property, not including mortgage. And as long as you can increase the income by increasing rents or reducing expenses, you can you can keep continuing to add value to that property and increase the value of the property. So scale, let's talk about scale, right? You go buy a single family unit in Austin, even last year, you probably had to pay 300,000, 400,000 at the very least. It was the cheapest property you could find. We bought a property in 2020 for 114,000 a door. It was a 308 unit property in Bells Branch Parkway. So obviously our cost per unit is much lower because we're buying it at a larger scale. The management cost also is lower. If you're paying 8 to 10% average on a single family home, we are paying 3 to 5%, usually 3%. So everything benefits from the what we call the economies of scale, right? A rehab cost. If you want to rehab a property, renovate a property, your material cost, your labor cost is all retail cost, right? You go out there and find a handyman or a general contractor. We go out, we employ plumbers. We basically they're on our payroll, right? So the lower cost reduces because of the scale at which we operate. The loans, you go and get a conventional loan. It is counted on your credit report. Your debt to income ratio is affected. They're looking at all of those things to give you a loan. Whereas commercial is what we call a non-recourse loan, except for land. Land is usually a recourse loan. It does go recourse for the sponsors. Like if I'm putting a land investment together, it's a recourse for me. And sorry, it should be a non-recourse for non-recourse for all apartment investments, for example, which means it doesn't go on our personal credit. It goes against the property. So what the lender says is non-recourse means that they basically take the property as the collateral for giving you that loan, right? They do look at the net operating income of the property, how the property is performing, as well as the liquidity and net worth of people who are buying that property. And investors are not counted in that because they are structured differently. So let's talk about the different types of real estate besides residential, which all of you were familiar with. We have commercial, we have office, we have retail, apartments, senior living, self-storage, medical offices, just a whole lot of them. We have something called industrial. A lot of you might have been familiar with this because Amazon is buying up warehouses all over the country. And with COVID, we've had a huge increase in the need for commercial warehouses because all this e-commerce is happening. People are buying everything online, right? I, for one, live on Amazon and I order everything on Amazon. So all this inventory has to be stored somewhere. So industrial has become a big growth area in real estate. If special purpose, you could invest in raw land, you could invest in farmland, you could invest in mixed use facilities where you have a combination of apartments plus retail plus maybe some kind of entertainment and all of those things. We have schools, churches, government buildings. So it's possible to invest in every kind of real estate beyond just single family homes. Now let's talk a little bit about what's a cap rate. This is a very big high level overview of what a cap rate is. I'll just get into just the surface of it, but there's a lot more to cap rate than this. So essentially what it is the way of assessing the investment potential in terms of profitability and return potential. So what does this mean? Let's say I put in $100,000 and I make $1,000 for every $100,000. Essentially, then you're making 1%, right? If you make $10,000, you're making 10%. So that's all it is. It's like assuming it's the yield of a property, assuming that it's purchased all cash. Obviously, you're not going to do that. You're not going to go buy it all cash. You're going to leverage it. You're going to ask the bank for a cheaper loan, and then you're going to put your down payment, right? So when you do that, your cap rate, your actual returns go up because now you're leveraging and buying with maybe 70% bank loan and 30% your capital. So you're putting much less money, so your returns can go up a little bit more. So in multifamily and commercial investments, the cap rate that we look at is the perceived risk of investing in a market. It's a different way of looking at it. So let's say you are an investor, you want to invest in Austin. You think Austin is a pretty low risk market with all this stuff going on, the job growth, people coming in, and all of that stuff. So you're willing to take a much lower return on your money because it's a lower risk for you, right? So let's say I come into Austin and say, okay, a 3 cap property is okay. You know, I make $3 for every $100 I put into this property. I'm willing to live with that. But if I go to Brownsville, Texas, I'm going to want more money on every $100 I put into Brownsville because it's a higher risk for me to be in Brownsville than in Austin. So cap rates also proportional to the perceived risk of the market. So if you want to invest in a market like Austin, and someone asks me, where would you invest? You go invest in San Antonio, you're going to get better cap rates than you'll get in Austin because the risk of investing in San Antonio is slightly higher, but not so much more than Austin. But then compared to Brownsville, maybe San Antonio is safer, right? So you'll pay, you'll get it at a lower cap, which means you'll pay more, right? Lower cap means paying more for the same property. Higher cap means paying less for the same property, if that makes sense. So whenever there's lower supply and higher demand, the cap rates will, what we call, compress or become lower because investors are willing to take a lower yield in a low risk market. What is forced appreciation? This is where commercial is very different from residential. We have this concept of forced appreciation. Investors can control the value or increase in value of the property. And how can you increase the value? You can increase the value by increasing the money that the property generates, or what's called the net operating income. Net operating income is income minus expenses of the property. The expenses do not include mortgages. So you can increase the NOI by increasing income or decreasing expenses, or usually both. That's what we focus on when we buy existing assets. We want to force the appreciation on these assets. I'm going to have to remove this. So let's talk a little bit about syndication. What is a syndication? So essentially, we want to take a group of people and we want to go buy something that we couldn't buy by ourselves. So let's say I want to buy a $10 million building. I need maybe 3 million, like 30% of it, and I'll take a $7 million loan and I'll put 3 million of investors together. Each investor puts in $100,000. I need 30 investors and I'm done, right? So that's one way of putting money together. So essentially, it allows us to pool our resources and share in both the risks and the upside potential of further returns on your investment. So it allows you to go in with much smaller dollar amounts than if you were to go buy a $10 million property. Most of us here, at least, not nobody, but most of us here don't have 3 million in the bank to invest tomorrow, right? So that's when you benefit from a syndication. You get a broader investment choice. You don't have to go buy a single family home. You can invest into any commercial investment that might be performing better than your single family home right now. You benefit because it's a truly passive activity. You're not dealing with a property management company. You're not dealing with a tenant. You're not dealing with the headaches of owning a house. You want to invest in real estate still and achieve that diversification, but you don't want to deal with the daily hassle. Let's talk about economies of scale. I kind of spoke about how we benefit. We benefit from economies of scale, both in terms of expenses, in terms of rehabs. All of the costs are much lower when you're doing it on a larger scale, right? So who's a general partner? I'm a general partner in the investment. What that means is I perform the underwriting. Underwrite is really a fancy way of saying financial analysis of the investment. You know, I basically tell you, okay, in 3 years, this is what I expect the investment to make. Here are the assumptions. Here is the current income of the property. Here is what we expect it to be, and, you know, put everything together for the investors. We identify the asset, we acquire the asset, we talk to brokers, lenders, we have to talk to investors because investors have questions. We have to send monthly or quarterly updates to investors. We work with attorneys. There's a lot of stuff which goes on behind the scenes of this syndication. We work with property management companies. We report monthly. We give money on existing assets. We provide the distributions. We do it monthly, quarterly. We also track the business plan. So every property we buy is really a business. We put the business plan together, we track the business plan, we develop the business plan, we dispose the asset and get the capital back to the investors. So who is a limited partner? You are the limited partner. If you want to come into one of these investments, you provide the cash. You usually get a K1 as a partner in the investment. You might receive cash on cash distributions for existing cash flow assets. So let's say I buy an apartment building that's making money, you do receive cash distributions. But if it's, let's say, a piece of land we're investing in, you might not get cash, but you'll get higher returns on the back end when we sell the property or we recapitalize it. So you also receive property reports on regular basis, maybe monthly and quarterly. You can be equity investor. You benefit from both cash flow and appreciation of the property. You can also choose to be a debt kind of investor. What that means is you just say, hey, I want 12% a year, 1% every month. I don't want to deal with, I don't care if the property appreciates. I just want to get my 12% a year in my money in my account. So that's an option. Both sorts of investors, you might get depreciation. So let's say you make 12%. I have an investment which is, we are paying 12% per year, 1% every month on the investment. And we're also giving investors a way to not pay taxes on that until the end of 2 years, right? So they get to defer the taxes on that investment. So they're really just getting 12% into their bank accounts. So what kind of returns are in the syndication? I mentioned cash distributions as well as equity returns. Equity returns means that the property has appreciated, whether it's market appreciation or forced appreciation, both of those can happen. And then we pull out the cash, maybe with a refinance, maybe we get a new set of investors and then these investors can get their money back. Maybe the bank gives us a loan because the asset is worth so much more right now, they get us more money. We also have different asset types here, right? Land and new construction might not have cash flow, but might give you better returns because we do buy land investments. We take them to the development process and increase value of the land. So we might buy land at $3 a foot and sell it at $6 a foot or $12 a foot. Once we have entitled the land. So that adds value to land. We are able to generate equity growth through that. There's also risk factors where, what are the risks? A lot of investors ask me. Cash flow can be impacted. Let's say I've had an apartment building and people are not paying me rent. Obviously, there's increased vacancy, bad debt, but it'll impact me less or impact us less when we have a 300 unit property versus you own a single family home where your tenant stops paying, right? So it impacts us much less than owning a single family home. So how do we give investors money back, right? There's two ways. One is cash flow, one is equity returns. And there are two models you'll see out there. And generally, I like the preferred return model because it gives the investors a certain return where only above which we get compensated. So let's say I have an 8% preferred return. That means that the first 8% goes to the investors and we don't get paid at all, right? If I tell you it's an 18% preferred return, all of the project profits up to 18% go to the investor first before we get paid. So that's a great model from an investor perspective because 100% of that preferred return goes to the investors. But let's say the project makes more than that, then we get to dip in and we get paid, right? So you kind of want that. Whereas in a straight split model, even if the project makes 4%, it's still split 80-20, 70-30. There's no preferred return for investors. So I prefer this model from an investor perspective. as an investor myself, as a passive investor in many projects, I always go for the preferred return model. Equity returns. So let's say I tell you, I'm going to pay you 8% returns, and after that, it will be a 70-30 split after the preferred return. What that means is after the 8%, if I make 12% that year, the remaining 4% is split in a specific ratio, 70% to you guys, 30% to us, 50-50, 15-85. It can be whatever depending on what you're investing into. So usually maybe a land deal like this, right, where I'm giving a high pref, which is 18 pref, might come with low splits for the investors of 15%. Whereas when I'm giving an 8 pref on an apartment investment, which is lower compared to the land, then you might get 70% on the back end of the equity returns, and we might get only 30. So we always want to make sure that the investors meet their target returns before we get paid, right? That this is how we get incentivized to work. Here again, it's a straight split. So regardless, even if the project makes 10%, you still get to share your 10% with the sponsors, which is the general partner. Hurdles. This is a little bit more complicated, and I say, okay, if I achieve this particular, what we call an internal rate of return, or let's say I give you 15, in this case, let's say 8 pref. So I might say 8 pref, 100% of it goes to you. From 8 to 15, we'll do a 70-30 split. After we hit that 15% target, the split goes to 50-50. It could be structured like that. So we want to essentially, it's in our interest then to increase your returns, because that's when the splits become more favorable for us. So how do we structure a syndication? How do people participate in a syndication, right? So usually we set up an LLC, and people ask me this all the time, should I set up an LLC? You can if you want to, you don't have to, because we already set up LLCs here, which protect you from a liability standpoint. But if you want to put another LLC, you can be an LLC here investing into an entity, right? And there are two kinds of partners. There's limited partners, they're general partners. We come in as different classes in this LLC. We'll have an operating agreement for the LLC, which spells out how these investors are going to be treated, how the partners are going to be treated, who gets paid what, how much percentage splits we have, let's say 70-30, 15-85, what is the preferred return for the investors. All of that will be spelled out. And we as general partners will have our own LLC, and we might come into the investment. And overall, this LLC will buy the property, and this LLC will own the property. And you guys, when you invest, are a part of this LLC. And if you have any questions, feel free to type it in the chat box. So let's talk about the types of investors. So SEC, all these investments are have to go through Securities and Exchange Commission. We do have to file something called exemptions with Securities and Exchange Commission, because they want to make sure that when we raise capital, we do it legally, right? We always work with attorneys who are Securities and Exchange Commission attorneys, or what we call syndication attorneys, and they draft all the paperwork for us. And then we present the paperwork to you, you sign the paperwork, and then you send us the money. So it all is a legal channel. And SEC defines you don't have to be an accredited investors to invest in a project. Some of these projects are for accredited investors only, but some projects are open to both. So I'll talk a little bit about which one is open to which. First, let's talk about who's an accredited investor. This is the current definition. SEC has put forward a proposal to change this definition to increase the net worth from 1 million to 10. I don't think that's going to happen to 10. Maybe it will settle around 5 million, because the value of 1 million has gone down significantly over the last 10 years. So an individual who has earned income that exceeded 200,000 alone, or $300,000 with a spouse. So if you made over 200,000 by yourself, or you and your spouse made 300,000 together, for the last 2 years and reasonably expect the same for the next year or the current year, you are a accredited investor, or you have to have a net worth over 1 million, either alone or together with your spouse, but you cannot include the value of your primary residence in this 1 million. You can also be an LLC, a trust, a bank, and that's a little bit different on how it's calculated. When you have an LLC, your LLC has to invest about 5 million in assets before it can become an accredited LLC, or every single person in that LLC has to be accredited. So if you have an LLC with 5 friends, all of the 5 people have to be accredited separately for the LLC to be accredited. Who's a sophisticated? Like I mentioned, we don't need you to necessarily be accredited. That we have open opportunities for sophisticated investors. We expect you to have enough knowledge and experience to understand this investment, and that's my goal, right? To get you there. No income requirements, but we can only sell this to 35 accredited, non-accredited or sophisticated investors, whereas the number of accredited can be unlimited. So we want you to be educated in some kind of investments. So I usually ask people, okay, have you done any stock investments? What's your risk appetite? How much money do you have to invest? Is this your last dollar? We don't want to take money from the last. This is all the savings I have here, put it in real estate. We don't do that. We want to make sure that you are diversified and you have capitals outside of this. And this is not, you're willing to take risks, right? Bottom line. So let's talk about the types of syndications. Like I mentioned earlier, some of these allow for only accredited investors, some of allowing for both accredited and sophisticated. When we create what's called a B syndication or 506B, we file an exemption with SEC saying this is Reg D 506B, and we will only take in investors who are accredited or up to 35 sophisticated, but no more. We do know our investors, we know who they are, we have a pre-existing relationship with these people. Maybe we don't know someone, but existing investor, let's say I know you and you referred me to someone, we are allowed to take that investor in, but we can't go out there and put it on social media and say, hey, I want investors for this project. When we structure a syndication like this, we are not allowed to do what's called a general solicitation. We don't need to verify accreditation. We just, let's say you are accredited and you say, hey, you are accredited in your firm. We assume that you're accredited. So in that sense, it's called a self-accreditation. We are not doing a verification of your accreditation. Whereas in a C, we have to do a third-party verification, and we will send you to either an online source to do that, or your CPA or attorney or financial advisor has to provide us a letter saying this person is accredited. They either have income accreditation or they have net worth accreditation. We don't require to have any previous relationship with you. You could just be someone we don't know and you can come invest with us as long as you're accredited. And we can also post this on social media, public platforms. We can do it anywhere. So a lot of these crowd-funded investments might be a 506C investment. So let's talk about the different types of real estate that it can syndicate. We have what we call a value add play, where we buy an apartment building, we upgrade units, we increase rent, reduce expenses, requires capital expense dollars, right? We need money to renovate these apartments. Yield play is when we just buy a property for its yield and we just hold, right? It's possible in certain asset classes, but not single family and multifamily anymore, to do what's called an yield play. 10 years ago, even 5 years ago, you could do an yield play. Now the prices are too expensive to do what's called a yield play. So we're almost always doing some kind of a value add play. We can also do both, right? We have some yield and some value add. We bought a new apartment in Fort Worth last year. It was a brand new building. There's really not a whole lot of value add you can do in a brand new building, but we added EV chargers for the tenants to get some money off of electric vehicle chargers. We added Amazon lockers. We added a few things, a few amenities to increase rents, right? So we did do some kind of a value add strategy, but mostly we bought the asset for its existing cash flow. Um, we can do new build. We called it build for rent, build to sell. We can build and rent it. We can do a whole complex of single family homes to rent, right? It's called build for rent. We can build it and sell individual townhomes to investors. We have done that. Low maintenance, right? With new builds, there's not much maintenance. There's little or no cash flow though when you're constructing. Land banking is essentially just banking on buying and holding land. A lot of you people in India have done it, right? Like a lot of, I don't know, you guys probably know someone in India who's done buying land and doing nothing on it, just waiting for a few years. But there's no cash flow. We can't just take investors' capital and just sit on it, right? So we generally don't go with the land banking strategy, but instead we go with the land development strategy. So we buy and actually entitle the land, because entitlement increases the dollar per square foot, makes the land ready for building. We add roads and utilities to further add value to that. So let's talk a little bit about equity growth and cash flow. And I think this is really important to consider from an investment standpoint, because a lot of people focus on one or the other. Some people just want cash flow, but there's place in your portfolio for both. Because when you're focused on equity growth, you can get very high returns. When you're focused on cash flow, your returns automatically reduce, because nobody's going to pay 25% return in cash flow for you. But we do 20-25% returns in equity growth, right? So some equity growth investments are good, because what you want to do with your portfolio is you want to put some aside for cash flow. Let's say you have two people in the household, both working. Do you really need the cash flow right now? You probably don't, right? You want to focus more on equity growth, because you want to increase the amount of capital you have faster. If you're going to create 25% returns a year, in 4 years, you've doubled your money, right? So that's powerful to do with money, rather than just get cash flow and get 12%, right? Hold period is typically shorter for the equity growth investments. We might do 1 to 4 years, let's say 3 years, 4 years. Here, it's typically longer term. When we're doing any kind of cash flow, we might do 3 to 5 years. When we focus on equity growth, there is a lot of equity growth here, but there's no cash flow. Here, there's income, but there's less equity growth. So if I'm buying an apartment building, I don't have as much equity growth, because I'm already buying at these crazy prices. And so there's less equity growth and more focus on cash flow. The investment risk can be high. Again, any investment comes with risks. So if I'm buying raw land, maybe the risks is a little bit higher, but we identify those risks and we mitigate those risks. And then in cash flowing assets, because it's cash flowing, the risk is lower, right? This might be a good strategy for younger investors. They don't really need the cash flow right now. They're working right now, or full-time people with sufficient income, let's say two family households with a lot of income. You want to focus more on equity growth. Older investors who are focused towards retirement, as you go towards retirement, you want to look more for cash flow investments. You want to boost your income from these investments, right? The investment vehicle is also important. Retirement accounts are really ideal for equity growth, because you don't really take the cash flow from a retirement account, right? It goes back into the retirement account. So why not let it grow at a faster pace, because you're not using that money. This is good for both savings and retirement. You can do some portion of your retirement in equity growth projects, some portion in cash flow projects. Typically, I tend to put my cash in these cash flow assets, whereas retirement accounts are mostly deployed in equity growth land projects. Depreciation, again, same reason, right? There's no improvements in land projects, generally no depreciation for you to collect. So again, perfect for retirement, because you're not paying taxes on your retirement account anyway. So what will you do with passive depreciation or losses? There's nothing for you to use it against, because you're not paying income on those retirement accounts. When you start paying not income, I meant taxes, sorry. When you start paying taxes on your on your return. So let's say I get to 12% return and I need to pay taxes. Depreciation really gives you a tax break on your returns. So this is when it's more useful to have an existing asset. All right. Let's look at this. The last one I want to talk through is sources of capital, right? You can use cash investments. You can use self-directed IRA investments. You can use what's called a solo 401k investments. A lot of people have money sitting in an employer 401k, and they ask me, how can I do this kind of investment? You can roll over your employer 401k into a self-directed IRA. But unfortunately, your employer will not let you do that unless you're between jobs, right? There are other ways to do it, but they cost about $3,500 to split an existing 401k maybe between you and your spouse, and then the spouse can roll over that 401k from your employer into a self-directed IRA. So we also have cash investments. If you have cash sitting around, you can invest. We do provide K-bonds every year for tax filing. And then the last one is great for businesses, people who have any kind of businesses where they're self-employed. It's called a solo 401k. And I will actually do a webinar in May on investing with retirement accounts. And that will be completely dedicated to different types of retirement accounts and what the pros and cons of each one are. So when you come to us and you want to invest in a syndication, here are all the documents we'll have for you. We'll have what's called a PPM. We have to disclose legally everything about this deal and all the ways, and don't worry about this one. We have to discuss legally all the ways the deal can go wrong. Doesn't mean it'll go wrong, but we're required by SEC to provide those kinds of details, right? This is the risk, this is the risk, this is what can happen to your capital. So a lot of new investors are really get worried, but honestly, even when you buy a single family home, you're taking on all those risks, right? You just don't have anybody spelling it out for you, right? We have an operating agreement about how the LLC will operate. If we have disputes, how will the disputes be resolved? We have a subscription agreement where you say, okay, I want to put in $100,000. I get 100 units of this investment. Each unit is $1,000. You have a questionnaire where we'll ask you if you're accredited, how do you know us? If you're sophisticated, how do you know the sponsor? Because we need to have an existing relationship. Finally, the business plan. Who are we? Who's the sponsor? Like, who's putting this investment together? What's our credentials? What have we done before? What are the financial look like? What are the returns? What are the planned improvements? What's the hold period? What are the specifics of the market? Why do we like this property that we're investing into? All of that will be in the business plan. So with that, I think I'm going to pause a little bit here. I can get through all of this, but I have a lot of content here and I want to be mindful of the time. It's 8:10 and I want to make sure that I answer your questions. So these are some of the asset classes in commercial real estate that you can invest into right now. Warehouse and distribution is doing really, really well. Multifamily is doing great. The green shows what's doing really well. The orange shows what's not doing so well. And guess what? I'm an investor who goes into the orange. I want to go into senior housing because long term, this orange is going to be green, right? You want to get in when it's not doing so well. Same with medical offices. They're going to do really well in the long term because people fall sick all the time. Doctors are not going out of business. America is one of the oldest populations in the country and in the world. And there are more Americans turning 65, more than 10,000 Americans turning 65 every single day. So I believe that senior housing is here to stay. So a lot of questions I get, and I'm going to preemptively answer this. What guarantees do we provide? We don't use the G word or the guarantee word. We provide projections on this investment. We say, okay, this is what I project, or we think the investment will do. This is what we think it can deliver, right? Can you invest with your retirement account from Fidelity? You cannot. You have to roll it over into what's called a self-directed IRA, and I can help you with that, or a solo 401k. If the cash flow is impacted because of adverse conditions, we will temporarily withhold cash flow, and then we had to do this during COVID, and then we caught up with the distribution. It's not lost, you'll still get your money. It might be a little bit later. If you need your money before the hold period expires, in case of an emergency, we will allow you to transfer that particular investment interest to someone else, assuming that you can work out that someone else and then they can agree on a price with you. We don't like to do that often. We prefer not to do that. But if it's such an emergency that you need your money, we can work through it. Do I need an LLC to invest? You do not. Like I mentioned, we set up layers of LLCs. So if you want to, you can. If the market conditions are unfavorable and I tell you it's a 3-year period, we'll just hold longer, right? We don't want to lose money at the end of the day. We want to make investors money because I want investors to keep coming back, right? It's in my interest to perform. What are the fees are paid to sponsors? We'll always disclose all the fees we're getting paid. And whenever we do a investor deck, all the information on that fees will be there. What's the worst that can happen? The worst that can happen is it performs so badly that the bank comes and forecloses on that investment, in which case we lose all the capital. So obviously we've never let that happen. We don't want to ever let that happen, right? It's kind of like giving up your home that you bought because you can't pay your mortgage. We don't want to get to that. We do a lot of stress test and analysis to make sure that we're not buying properties which have a danger of that. How can I do my own due diligence? You're welcome to go to the property. You're welcome to look at Google Maps. If you don't live close by, you can do whatever you want to do, and we're happy to give you that information. All the returns that we specify are net of all the fees. So those are really the lots of questions I get. And a lot of people worry about, I want to end with this. And I say a lot of people are worried about missing opportunities, that it's too late to invest in real estate or the opportunity is gone. And I don't believe that to be true. I just think opportunities shift. Maybe the opportunity is not in buying single family homes anymore. It was 10 years ago, right? It was even 5 years ago in Austin, although we didn't know that. But 10 years ago, we knew that there's a lot of opportunity in buying a single family home, but people are also scared when market crashes, right? You're scared to invest when the market crashes. And I like Warren Buffett, and he says, when people get greedy, you start worrying about that. And when people get foolish and start investing, then you need to step aside and let them people get greedy about investing, then step aside. So it's kind of contrary to what we think. I feel like there's always opportunities. You just need to keep your eyes open and invest into different things where there are new opportunities coming. The bigger question is, are you prepared to get on the opportunity? So let's say senior living right now, people got scared after COVID, right? But there's an opportunity in that fear because people are afraid to get in there, which means there's an opportunity for us to capitalize on that fear. If you can get over the fear, right? So with that, I will go to the questions. I think there's a few questions here. Someone typed their email. You can, if you have any, so here's a good place for you to go. You can go to cherrystreetinvestments.com. If you're interested in investing, there's also a lot of resources there. You can download different ways of real estate. I have a little ebook. I'll just share it with you quickly here. You can type, I'm just sharing my screen here. cherrystreet.us, it will redirect you. And if you go to downloads, there are some resources. There's an investing strategy ebook that you can download. If you're interested, there's also a due diligence checklist. So when you want to invest, there's what due diligence do you need to do, right? This is a good checklist to have. You can download it, print it out, and go through your own for the first time. There's a lot of blogs, webinars, videos, podcasts. a lot of stuff I do. I also do youth education. So if your kids want to learn about investments, about, finances, I've done a series of webinars for the kids as well. Let me also, if you're interested in knowing what investments I have already done with my partners, these are all the investments we have currently going on. A couple of them we sold. We sold this one for 40% returns in Atlanta in 2 years instead of holding it for longer. This one we did 66% returns per year. Again, every investor project does not pan out like that, but we were fortunate. What else? So if you're interested in investing, you can hit the invest button, and you can fill out your email, name, and whether you are accredited. If you're not sure, you can say unsure. What this will do is if I put together an investment opportunity for you, you'll automatically get an email notification saying this is the investment opportunity. It's available for you to invest in. So if you want to do that, please feel free to go in and type the invest button on cherrystreet.us. Any questions? Let's see. Can we send a link to the recording? Yes, of course. I cannot take your emails right here because I have to cut and paste from the chat box. So if you could please go to my website and hit the invest button and put in your stuff. I will share an email link to the recording. It'll go on YouTube. So if you also want to go to my YouTube channel, I'll share my YouTube channel link in a second here. So you can just type bit.ly/cherry -street. And then that's a short link for the YouTube channel. So you'll be able to go to the channel and subscribe to the channel and watch the videos, and the YouTube and the recording of today's webinar will also be on the channel, and also share it with TCA so they can send out an email to the webinar today. Any other questions? Let's see. What is the exit policy for a syndication? I'm not sure what you mean by exit policy. So let's say we told investors, okay, we'll do 80% returns in 5 years. And let's say I was able to achieve that in 2, I might sell that in 2, right? Because there's no point in holding investor capital if we're able to achieve better returns in a shorter period of time, unless the investors say, hey, we don't want to sell, right? It's a collective. As a collective, we make that decision. So there is no one way to do it. In some projects, let's say a land project, we are like just doing a 2-year hold. If let's say the project is actually done in a 1.5 years, our entitlement process is much faster. There's no reason for me to hold investor capital. I'd rather give you 25% a year for a 1.5 years and give your money back. I will type the YouTube. I'll type a couple. Yeah, for sure. I'm typing the YouTube link here in the chat. No, actually, I didn't type it for everybody. Sorry. Yeah. So the YouTube link is in the chat, and also my website is also in the chat. I'll just type here, cherrystreet.us. Those will be the best ways to contact me. I also have my phone number here. I'm good on text. I'm not so good about picking up calls. You can also send me an email, kavita@cherrystreetinvestments.com. I love your feedback, and if you have any questions, feel free to let me know. The exit decisions is not necessarily always based on voting with investors. We also have voting rights in the property. So we will take voting based on investors as well. But if it's, let's say, a 5-year hold, and we think it's a good hold period, 5 years are done, we don't need to tell investors, hey, do you want to exit or not, right? If we think 5 years is done, we have achieved the investor returns, we might exit. But we will always, let's say we plan to exit sooner, we will ask the investors, or we will tell the investors, hey, we are exiting. Does anybody have any objections? We want to hear what the investors have to say. Does operating agreement supersede PPM? If that's the point, then what's the point of having PPM in place? So there are clauses in the PPM which are not in the operating agreement, so it doesn't necessarily supersede the PPM in every way. But let's say there are some clauses which address the same thing, then the operating agreement takes precedence over PPM from a legal standpoint. So let's say there is a clause that is not even addressed in the operating agreement, the PPM still holds because that clause is not. So let's say I'm talking about all the risks and merits of the investment in the PPM, all the risks. I highlight all the risks. That highlighting of the risk is not even covered in the operating agreement. So the PPM still has a big purpose. The PPM is where everything about that investment is outlined. The operating agreement only outlines the roles and responsibilities of the limited and the general partners. But if there is any overlap in those two, then the operating agreement supersedes PPM. So the question was, does the operating agreement supersede PPM? If so, what's the point of having PPM in place? What's the least profit you made on all of your projects? That's a good question. So I have 2 full cycle projects because I started 2019 as a general partner. So we sold 2 properties since, and both have done really well, 40% and 66% a year. But that said, I have been a limited partner in other investments. And the least I took home on one of the investments where everything went wrong that could possibly go wrong, and that happens too, we made 11% a year on that particular project. We never got paid a dime on that project. I wasn't a general partner. There was no cash flow because every dollar that came in went towards repairs and broken pipes and all sorts of things. And then we finally got paid. We made 11% a year, which, considering everything, I got my money back and 11%, I was quite happy. I think I've answered all the questions. Again, if you have any other questions, feel free to reach out to me, email, or email would be the best for questions. And I'm happy to, I usually set up one-on-one calls with investors to figure out what their goals are, how I can help them meet their goals. So there's an option to do that as well on my website. You can schedule a call with me. Okay, that wraps it up. Thank you everyone for joining and have a wonderful evening. I appreciate you being on here. Have a great evening. Thanks. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.